Familiar. MEFA is a nonprofit state authority here in Massachusetts, based in Boston. We were created back in 1982, so we've been in the business for quite a while. We help families with planning, saving, and paying for college. We have products such as college savings plans and loans, but we also offer a tremendous amount of guidance for families and education through every step of the college enrollment process, from saving while children are little babies to where you guys are right now, helping to pay for college and everything in between with guidance and education. So we'll go through some of the resources that are available for you throughout the webinar today. And at the end, we'll have a link for you if you want to sign up for any one-on-one appointments. We can dig a little bit deeper into your individual circumstances as well. So again, my name is Stephanie Wells, and I've been at MEFA since 2001, so closing in on 20 years. I've been working in this industry my entire career since getting out of school, and I do a lot of work with high schools and colleges and community-based organizations. And one of my favorite things to do is really help families, especially one-on-ones where we can really dig deep into your own situations and come up with solutions to help pay for college. So I really love working with families, and we'll go through a lot of resources for you today. So just a couple quick housekeeping details. Everybody is on mute except for myself and my colleague Jonathan Sparling, who will be answering some questions in the chat feature as we go. So feel free to type those in. You can see those in there. Type those in throughout the whole webinar. We'll stop a couple points throughout the webinar to take some questions, and Jonathan will also be answering them individually as we go. And then at the end, we'll stay as long as we need to until everybody gets their questions answered. So just know that if you're talking to me, I can't hear you, but feel free to communicate with us through the chat feature. All right, so let's get started. Here's what we're going to talk about today. Want to make sure everybody understands loan terminology so that they can be a wise borrower and be a good shopper when looking at your different options. You'll probably hear me say a million times today, to be responsible with borrowing, to not borrow if you don't have to, minimize borrowing as much as you can. That's really important. That's why we're here. We are a nonprofit, so we want to make sure families are making wise financial decisions, especially in today's environment where things are so uncertain with a lot of families financially. We don't want families to put undue burdens. So hopefully we can help you with minimizing borrowing. Talk about federal direct student loans, which are going to be one of the first options that you look at if your family does need to borrow, and understanding the cost of borrowing. So it's not just about the interest rate. There's a lot of different features of loans that can add to the cost of taking out that loan. Who are the trusted resources you can look to if you need assistance throughout this process? And what's next? So what can you expect from today on with timing and the loan process, college billing process? We'll go through all of that today. Okay, so understanding loan terminology, the first thing we want to talk about is obviously the interest rate. It's the biggest impact on the cost of a loan. So the interest rate is the percentage of money that the lender charges for using that money. So I'm sure everybody's familiar with credit cards or car loans. The interest rate is a big driver in the cost, but there are differences between the types of interest rates that you might see for different types of loan programs. There are fixed rates and variable interest rates. Not every lender is going to offer both. Some offer both. Some only offer maybe fixed rates, for example, with MEFA. But the fixed rates, it really is going to depend on your personal preference of what type of loan you want to take out. So there are benefits to both. So fixed interest rates, the nice thing about those is that the rate stays the same for the life of the loan. So you have a monthly payment amount that's not going to change. You know what to expect. You can plan your monthly budget around that interest rate and that monthly payment. So it gives you a lot of stability. A variable interest rate is going to require that your monthly payment changes because the variable rate may change. It could be based on prime rate or LIBOR. We'll go through some of those loan terms that you can look at in your disclosure statements. And during a down market where interest rates are low, Variable rates might be a good option for some families, but you just want to be careful because those variable rates, as low as they are now, could go up as well. So those are some things that you need to think about. Also with variable rates, you want to know what is the cap on the interest rate. So how high can that variable interest rate go? And that will be on your disclosure statements, and we'll show you some examples. So with most private lenders, such as lenders like MEFA or banks, the interest rate that you're charged is going to be based on your credit. So the borrower's credit. Typically, if it's a mom or dad borrowing as a cosigner with a student, we're really looking at mom or dad's credit rating to determine the interest rate. So the higher your credit score, the lower your rate. The interest rate may also be tied to your repayment option. So different types of repayment options have different risks associated with them, and the rates will be determined based on the repayment option as well. So it could be a combination of your credit profile and the repayment option that you choose to use. The APR is a good number to use if you're trying to compare different types of loans, particularly if you're looking at a fixed rate and a variable rate. I like to look at the APR as a number you can use to compare apples to oranges. So it's the annual cost of the loan, including fees, if there are any fees on the loan. It's expressed as a percentage, and it's required that lenders show you what this APR is, and it is a good number to use to compare loans. So with a variable rate, for example, it might be prime plus 5%. Well, what is that actual interest rate compared to a fixed rate? So that APR is a good number to look at when you're shopping and trying to determine what your interest rate will be and what your costs will be associated with that loan. Feel free, for those who are just joining us, to type in any questions as we go. You are all on mute, and we are recording this webinar, so we will share that with you as we go. So the repayment term is the length of time that you have to repay that loan. Now, when you're working with education loan lenders, such as MEFA, such as the Federal Department of Education, loans that are determined to be education loans should not have any prepayment penalties. So the nice thing about the repayment term is you can typically choose what term is going to work for you based on a monthly payment that's affordable. But with education loans, the nice thing is even if you choose a repayment term, let's say for 15 years, because you want to keep those payments low, you should be able to make prepayments on that loan, pay them off early, make larger payments, whatever you would like to do or able to do beyond that minimum loan payment, so that you can lower the total cost of that loan. So even though a loan may have a 10 or 15-year repayment term, it doesn't mean you have to take that long to repay it. You can always pay it off early. Even just adding an extra $20 a month to a loan payment can help you reduce that total cost of the loan, because the repayment term does have a direct impact, like the interest rate, on the total cost. So you do want to, make a good plan. Choose a repayment term that's going to allow you to have an affordable monthly payment. That's going to be very critical. You want to make sure that the repayment term you choose and the monthly payment you're looking at is something that your family can afford, because above anything else, we want to make sure that you're able to afford the minimum loan payment so that you can maintain your good credit in case you do need to borrow in future years or have other borrowing needs in the future. The repayment term provides families flexibility and options, and most lenders, such as MEFA, offer different types of repayment options to choose from. So one thing that you'll be able to see as you go through this process is an application and solicitation disclosure. So that is a statement that's going to provide you details on the estimated total cost of a loan. So every lender should have these readily available on their website when you're doing your shopping. You'll see a application and solicitation disclosure. I'm going to click on this link right here and I'll show you MEFA's disclosure. And while you're shopping, it should be very easy to find. So if you can't find it, then you might want to just question why you can't find that. So right here, we're on MEFA's loan page. If I scroll down here, you can see right here, disclosure. So I'll just scroll down and open up our disclosure statement. I'm going to show you a couple other disclosure statements from other lenders to show you some things that you want to be on the lookout for, but these should be pretty easy to find. So the initial disclosure you'll see before you even apply will show you the range of interest rates, and we'll go through this in more detail. And it's a good way to shop. Once you apply for a loan and you're determined what your interest rate is and your repayment option, after that school certifies the loan, you'll get a final solicitation disclosure so that you can see this same document based on your actual credit rating and the actual rates and repayment options that you've chosen. So you'll actually get two. Many colleges have lender lists and lenders that they've worked with in the past, so they may have loan comparison tools to help families through this process. And those disclosure statements should be readily available on the comparison tools as well. So just know that this is a good place to go to easily read the fine print. These application and solicitation disclosures are required of lenders in the education field. And the template that I just showed you is a standard template that every lender has to abide by. Obviously, we are allowed to put our logo on there and change the terms of our loan to match what we're offering. There are some things we need to update to show you what the loan cost is, but it is a standard federal template. So things you'll want to look at, as I mentioned, what are the interest rates? How high could that interest rate go, particularly if it's a variable rate? If you're on the lower credit score range, what's the maximum rate you might be paying? So you can look at these things before you even apply to determine if that's even going to be a good option for you. Are there any fees associated with the loan? Not just origination fees, but bounce check fees. If you have something like that should happen, late payment fees, things like that. With an education loan, there should be no prepayment costs, but when you're looking at other types of financing, make sure that's something you're looking at as well. And of course, what is that total cost? If you make the minimum payment for the full repayment term, how much are you going to pay on that loan? So here's one example of a variable disclosure statement for a variable rate loan. And I've blocked out the lender information. We don't want to pick on anyone in particular, but we do want to just show you some things just to be aware of. Buyer beware, good advice and tips. So here you can see a variable rate example. Because this person hasn't applied yet, it shows the range of 3.75 if you have a very high credit score, that's the lowest rate you'll have, and up to 10.125 if you're on the lower end of the credit score range. So that is the rates that you're looking at. However, you can see right here in the gray box, it tells you what the cap is on that variable rate, and that's very important when you're looking at variable rates to know how high can it go. Now that cap is really based on the state that the lender originates out of. So this one, it could go as high as 25%. If loans ever went that high, we're probably dealing with a lot more issues with the economy, but it is something to be aware of because you just don't know how high that can go. Another thing I mentioned is loan fees. So here you can see all the fees that might be associated with the loan. So there's no application fee on this loan. There's no disbursement fee, which is great. But if you're late, you can see 5% of your past due payment is going to be charged up to $25. And there is a $20 return check fee for this loan. Again, this is not a MEFA loan disclosure. It's for another lender. We don't have any fees on the MEFA loan, but I just want to show you some of the things that you want to be on the lookout for. On the second page of a disclosure statement is a lot of fine print. And of course, in the fine print is where you'll find a lot of good details as well. So for a variable interest rate loan, the second page, you'll be able to find out what is that variable rate tied to. In this case, it's tied to LIBOR, which is the London Interbank Offered Rate. And you can see based on whatever LIBOR is that day or that month, however the lenders are calculating the rate, the margin that the lender will add is going to be from 3.5% to 9.875%, depending on your credit rating. So very important to look at that as well and to know how often that rate could change. So that's going to be in the reference notes as well. So again, I know we have a couple more people who just signed in. Feel free to type questions in the chat feature, and my colleague Jonathan is answering those, and we'll stop a couple times as well to answer folks' questions. So here's an example of a fixed interest rate loan disclosure. And again, I just cut and paste pieces of the disclosure to fit it on the screen, but it is a 2-page standard document that every lender has to show you. Again, this is not the MEFA interest rate. This is not the MEFA loan disclosure. Just want to point out a few things for you. So with a fixed rate, again, you'll probably see a range before you apply of what the rate might be. And that range is going to be based on the credit score. So you can see right here in the small gray bar, it says the maximum rate is a fixed rate, which will be disclosed to you if you qualify. So when you're approved for the loan, that's when you'll find out what your actual interest rate is. But it is good to know, what's the top and bottom of that interest rate range. Another thing we see here, and this is also on a disclosure statement, and MEFA has this type of information in a loan payment calculator, which will show you, is that total cost. I've mentioned that term total cost a couple of times because it's a critical number to look at so that you understand that $10,000 loan that we're showing in this example is going to cost a lot more than $10,000 depending on the repayment option that you choose and your interest rate and how quickly you pay that loan off. So the disclosure statement is going to show you the highest interest rate for that repayment option and the total loan cost if you did receive that highest interest rate and took the full term to pay back that loan. Now, of course, if you have a lower interest rate, your total cost will be lower, and if you choose different repayment options and prepay the loan, there are ways to bring down that total cost, but it is good to know before you even apply for a loan, what's the worst case scenario that I might be looking at? So what is that total cost going to be? Very important number. So that's a little bit about the actual cost of the loan. Let's talk about who's on the loan. So let's talk about co-borrowers. Co-borrower is a term that I hear parents talk about a lot, and just want to throw it right out there to begin with that anybody who signs on the loan, whether you consider yourself the primary borrower or the co-borrower, whatever it might be, everybody who signs that promissory note has equal responsibility for that loan. So typically a co-borrower in the type of loans we're talking about is a creditworthy person, typically a parent, but doesn't always have to be, that signs the loan with the student. And the lenders, such as MEFA, we're looking at that co-borrower's credit. And so if you have two co-borrowers, we're going to take the highest credit score, so you'll get the lowest interest rate. So some lenders allow you to add an additional co-borrower. So you might have 3 people on the loan, the co-borrowers as well as the student, potentially. So that might increase your chance of approval, and also if you have higher credit scores, could lower that interest rate. So sometimes we've talked to families who, maybe mom and dad have had some difficulties financially, and they have the ability to pay the loan, but their credit's not so great. So they might have grandma or grandpa who has great credit co-sign the loan for them. So different families, you have to decide, what's going to work for you. But you should always feel free to contact the lender to talk through your options. We're always welcome to help you out at MEFA, whether you're using a MEFA loan or not, it doesn't matter. We're able to help you through this whole decision-making process. Now, there are some loans that some lenders have that offer a co-borrower release. So a co-borrower release means that The student, when they graduate, will have to make a certain number of on-time payments, which could vary based on the lender. And once they've done that, if they have appropriate credit to take over the loan, they can apply to have that co-borrower released. So MEFA does have this option. If you make 48 on-time payments, the co-borrower can be released. However, these loans tend to have higher interest rates. So the co-borrower release might sound like a great idea, and it is for a lot of families, but it might have a higher interest rate. So you really have to balance that. Oftentimes, after students graduate, there are loans called refinancing loans, which we're not going to dig into too much today, where students can maybe take over the loan from mom and dad, or vice versa. Mom and dad can combine one student's loan that they took out with another student. It really depends on the lender, but that's another good way to release borrowers off a loan by refinancing and maybe hopefully locking in a lower rate. So there are different options down the road. But I do want to just stress that, I talk to a lot of families who they're looking at their upcoming bill and wondering, how are we going to pay for this? Can the student take out additional funds? And the answer to that is typically above and beyond their federal direct student loan, which we're going to get into in a minute. They can't take out loans on their own without a co-borrower, without somebody who's credit worthy. Lenders just won't be able to take that risk for maybe an 18-year-old who has limited credit, might not be working full time. So it is important to know that if your family does need to borrow, the student's probably going to need a co-borrower, some sort of credit-worthy co-borrower. So let's just recap before we move into the next section and maybe take some questions. So a few things to think about. That interest rate, number one driver of the cost of the loan. How much are you being charged? What is the APR, the annual cost of the loan? That could include fees. So the interest rate is a little bit different. The APR is going to include any fees that are associated. So you can use that as a good number to compare interest rates and compare different loans. The repayment term is the maximum term that you're given to repay the loan. It's going to directly determine your monthly payment. The application solicitation disclosure, I just showed you a few examples. That's going to be a great place to find all the actual fine detail on that loan, all in black and white in a standard template, so you can compare different lenders' disclosure statements to one another. So everybody's sort of on an equal playing field as far as the information you're looking at. And of course, the co-borrower, who is equally responsible on the loan, and often the one that we're looking at as a lender to approve that loan. So we're going to stop right here before we keep going, and I just want to turn it over to Jonathan and see if we have any questions from the group.
Great, thanks, Stephanie. A few questions here, some we'll get to later, so I won't throw them out yet, but one of them is a good one. If someone asks, if my credit is not good, what are my options for student loans?
Yeah, that's a good question. So we are going to talk about the federal direct student loan in a minute, and that is a loan that a student can take out on their own. A freshman can borrow up to $5,500, and they do not need to have established credit. So that's one form of borrowing that we advise families to start with, is that student loan. But of course, $5,500, depending on the school, might not get you very far. So adding co-signers to a loan can help. It can also help decrease the interest rate if they have good credit. One loan that's out there, we're not talking about specific lenders' loans here today, but one loan that is another option that has lower credit standard is the Federal Plus loan that you can inquire about through your college or university. So that's another option. It's a little bit less stringent than some of the other loans that are out there. So those are things to think about. Payment plans, which I'm going to talk about in a minute, do not require credit. It's not a loan, but it's a good way to spread out your costs over a period of months. And so yeah, we're going to jump into other options to pay the bill beyond loans, of course. But those are some things that I would point to as solutions if your credit is recuperating.
That's great, and I think some of the other questions that we have right now we'll address in the next section. So I'm gonna hold on them for now, and we can keep on rolling.
Great, thank you, Jonathan. Okay, so let's talk about how to be a wise borrower. Being a wise borrower to me means borrowing as little as possible. That's step one. So how do you do that? I always advise families to take stock in every resource that you have available. So first, you might be looking at savings, maybe in a past income, so money that you've earned or saved. Usually we're helping families creating a combination strategy, so they're not using just one resource. It's a combination of resources to help pay that bill. So in our example here, we have a $20,000 balance. If you have $20,000 saved, great, that's easy. Pay the bill and you're done. But not every family has been able to save that full amount that they might owe. So you could disperse it over a number of years. So in this example, we're not able to pay the full balance with savings, but student worked over the summer and is going to contribute a little bit towards the bill. Maybe this parent has saved $16,000, so they've decided we're going to put $4,000 a year over 4 years of our savings. Maybe they have a 529 plan, so there's $5,000 off the bill. And then they look to what they have left. So present income is when you're using money out of your monthly payment, out of your monthly budget to put towards college. So a payment plan, which every college offers, is a great way to do that. And it's really the only way that a college will allow you to defer what you owe. You have to be using a payment plan to do that. So you can find that on the student accounts website at a college, bursar website. If we were to pay a $20,000 balance on a payment plan, we might be it's usually a 10-month plan, interest-free. That would be $2,000 a month for 10 months. So maybe you can't afford that, but you don't have to put the full balance on a payment plan. You could put a portion of it. So this family has said, I can't afford $2,000 a month on that payment plan, but I can afford $600 a month to put towards college. So they're going to do $500 a month on a $5,000 payment plan. So we've chopped our bill in half. Family still needs to borrow. They're borrowing $10,000, but by using a combination of resources and being smart and really utilizing as much of their monthly payment as they can, they're able to reduce their borrowing. So it might be easy to just say, okay, I owe $20,000, I'm going to borrow a $20,000 loan, $200 a month. That might be quick and easy, but when you're looking at that total cost of the loan, there's a big difference here, borrowing that $10,000 versus $20,000. So it's worth it to go through this process. So like I said, I always ask families, they tell me how much they owe. The first question I ask is, how much can you afford per month? And if it's more than that minimum payment of a loan, then I'm trying to get them to put some of that towards a payment plan and utilize their savings as well. So when I talk about savings, it's not just, what have you as a parent saved, but has grandma or grandpa saved, aunts or uncles? I know when my niece went to college, I had saved in a 529. I was able to help her pay for books for a couple years. So that was helpful. And I know I have a lot of friends and family who have done the same thing. Little contributions from different family members can help dig up those old savings bonds, things like that. Really take stock of what you have available. So the second thing you'll want to look at, and I mentioned this earlier, is borrow the federal direct student loan before any other type of borrowing. So this is a loan that's in the student's name. So this is part of the student's contribution towards the bill. So they can borrow this loan on their own without a cosigner. Really, it's the only way that a student can borrow up to $27,000 without maybe not working, maybe not have established credit, and put off payments for 4 years while they're in school. Most lenders won't be able to do that with a student, but the federal government has this loan available so that students can help contribute and pay their portion. So you can see the website here. Students will be borrowing this directly through the school. The college is the one who's going to process this loan. The interest rate for the upcoming academic year for students who are borrowing for this upcoming year is really low. The government just reduced the rate, so that's really nice for students. And the rate is going to be 2.75%. So any student who's borrowing this year's loan is going to be that interest rate for the life of that loan. Now you can see in the blue box over here, we have annual limits on what the student can borrow. So that's purposeful to, keep borrowing down. We don't want students getting in too much over their head. But if they were to borrow these annual loan limits each year, their monthly payment at the end of 4 years will be approximately $300 a month. For most students in most professions, from most colleges with most degrees, that should be somewhat manageable. It's when we have students borrowing this loan and taking over maybe cosign loans or other types of private loans that is just out of their affordability range. That's when we see families get into trouble. So it's really important to make a wise decision before the student enters school and in choosing what school that they're attending. So this direct student loan can come in 2 different types. So you'll see this on a financial aid award, typically. Some families, depending on your calculated expected family contribution, might receive a subsidy on a portion of this loan. So that would be termed the subsidized loan. So the interest does not accrue while they're in school. When they graduate, that's when interest will start accruing. So it's really nice to have that interest-free portion while the student's in school. Now, if we're using a $5,500 freshman year loan for families that qualify based on their financial need, up to $3,500 of that could be subsidized. It could be less than $3,500. Now, the unsubsidized portion of this loan is going to accrue interest when it's dispersed. Okay, so the unsubsidized loan could be anywhere from $2,000 if the family qualifies for that $3,500 subsidy, up to $5,500 for a freshman. So even if your family doesn't qualify for the subsidy, the student can still take out this loan. It will just be accruing interest while they're in school. And they can make voluntary payments on the interest while they're in school as well. And we recommend that you do that. It's not a lot of money. The interest rate's low. The borrowing amounts are low. But the more you can pay off that accrued interest while the student's in school, then when they graduate, they'll be left with just what they borrowed, not interest that is accrued that will then be capitalized and added to the principal balance upon graduation. So it is a good place to start if families need to borrow. There is a fee on this loan of 1.059% that's going to be deducted from the loan. So just note if the student borrowed a $5,500 loan, the amount that's going to be actually credited onto the bill through your student's account is going to be $5,441.75. So that's just good to know when you're trying to fix your bill and figure out to the penny what you're going to owe, to take that into consideration. So students will have to sign a master promissory note and go through entrance counseling. So the entrance counseling is a federal mandate so that students understand their rights and responsibilities as a federal student loan borrower. And this website that you see right here, that's where they'll be doing all of this work. Students won't do this until they've chosen a school, which most students at this point have. And the financial aid office at the school that you're attending, the students are attending, will be in touch usually through email or through the student's web portal to get them to do this, go through this process. And again, no payments are due while the student's in school. The nice thing about this loan is that not only do they not have to pay while they're in school, but when they graduate, there's a lot of flexible repayment options. There's options if they can't make payments. There's forgiveness options for public service. There's lots of different benefits on this federal direct student loan that you wouldn't see with any other type of loan. So this is where we want families to start if they do need to borrow. Okay, so let's talk a little bit about how the process works and how you're deciding what to borrow and when to borrow. Typically, with most lenders, it's an annual process, just like financial aid, where you apply for financial aid each year. You might need to apply for a loan each year. So with private loans and maybe the federal direct plus loan, you can borrow up to what you need, up to that school's cost of attendance minus your financial aid. So you can't borrow more than that. And that cost of attendance, remember, is not just your billed costs. That could include unbilled costs such as off-campus housing, books, supplies, transportation. We really try to encourage families to only borrow for the billed costs and try and pay for the unbilled costs out of pocket. So have the student working over the summer to pay for their books, things like that, work throughout the school year to pay for their transportation costs, things like that. Try to minimize your borrowing by paying out of pocket for some of those unbilled expenses. And we definitely advise families to apply for the full amount you think you'll need for the full year, because it's very easy to reduce the loan. You just call the lender, you can call us and we'll reduce the loan before the loan is actually dispersed. No interest is going to be charged on the loan until the money is sent to the college. So if you apply for the full academic year, let's say you need $10,000 and you get your fall bill and realize, I don't need $5,000 for the fall, I only need $4,000, just call the lender and say, reduce my loan by $1,000, and they'll do that. And you'll get a new disclosure with your terms of the loan based on the new amount. So that's really good to do, because it's better to apply for what you need, know that you have that approved, than have to apply each semester and go through the process more than you really need to, because it is easy enough to decrease the loan. And estimate what your monthly payment will be. So even though it's an annual process, if you're borrowing year one, you're probably going to need maybe to borrow years 2, 3, and 4, or you should budget that way and estimate. So just know, okay, maybe you can afford the first year's minimum monthly loan payment, but if you borrow 4 loans with that loan payment, can you afford the payment of all 4 combined? So just keep that in mind when you're looking at borrowing. If you're hoping the student will be able to help when they graduate, to help mom and dad pay these loans, just have an honest conversation of whether they will be able to do that. They will have their federal direct student loans they're paying, maybe wanting to get an apartment, things of that nature. Will they be able to afford to based on their career plans? Or maybe they're going on to graduate school and they still have more borrowing to do. So maybe they can't make these payments of these undergraduate loans when they get out of school. So it's very important to have those conversations now before you borrow. And typically the school will split the loan 50-50 between the fall and spring semesters. And lenders will send the money directly to the college. At least that's how MEFA does it. We send the money directly to the school and they will credit your account accordingly. The college does certify the loan electronically through our systems to approve the loan and make sure you're not borrowing more than your cost of attendance minus your financial aid. So this tool I want to show you real quick is a great tool that I use with families all the time. It's a great tool for planning. This is MEFA's student loan payment calculator. So I'm going to go live right in here real quick and show you how it works. This is great to use if you want to play with the numbers, run some different numbers, look at different repayment options. We use this all the time with families when they're deciding, do I want to use all my savings now, or do I want to borrow the full amount? What do I want to do? So if I'll just use $20,000, which is our example on the previous slide. We're looking at a combination strategy. And I'm going to plug in 4 years before graduation. So it calculates the right amount of interest. And I mentioned that rates are based on credit. So you'll want to just have a good understanding of what your credit's looking like. I'll just use good because that's the one right in the middle where a lot of families will fall into, and calculate. So you can see in the top blue bar are all the different repayment options that MEFA offers. So there's 5. And we have this set up from the lowest interest rate up to the highest. So we'll start with a 10-year loan, which means you have 10 years to make payments on that loan. And immediate repayment means that payments start while the student is in school. There's interest only, where you make interest only payments while the student's in school. A lot of families talk to me about, not wanting to make payments while the student's in school, hoping the student will take over those payments when they graduate. Those families are looking at deferred loans. But if you're looking at the interest rates on the fourth blue line here, you can see that the further you push out your payments, the higher the interest rate. So remember, we talked about repayment options being tied to the rate, and this is what we're talking about. And you can see the APRs down here, which are a range that will be determined based on your credit. But the very critical one, too, is the monthly payment. Can you afford that? A lot of families are surprised when we look at that lowest interest rate loan. Okay, $200. I didn't realize it would be that low. Maybe I can go with the lowest interest rate, the most affordable option. And then based on what works for your family, you can move up from there. But the critical number, of course, is that total cost of the loan. So that $20,000 loan, you can see as the interest rate climbs, as the repayment is pushed out, the total cost of that loan climbs with it. So prepayments, if you can do that, let's say you choose a deferred option and you want to make voluntary payments, that's going to help. It will allow you that flexibility with your monthly payments, but you can still try and keep that total cost down as much as possible. So that's a common question I get a lot. So this is a great way to, just play with the numbers, run some scenarios. The loan details are here, which will allow you to click into disclosure statements, and you can usually apply right on that screen as well, down at the bottom here. So that's a great tool to use, and we're happy to set up appointments if anybody needs to run the numbers. We can help you with that over the phone or through a virtual appointment. Get advice from trusted resources. Ask the lenders tough questions, look for their disclosures. They're being transparent about what they're offering, talking about that total cost and how those interest rates are determined. Utilize free resources from organizations, nonprofits that you can trust, such as MEFA. Work with the college. That's usually the first place I'm sending families to if they're shopping around, is to talk to the college about borrowing, see what they have for resources. Oftentimes they have lender lists of lenders they've worked with, where you can compare and contrast different options. That's always a good starting point if you don't know where to start. It can be easy to get lost on Google with all the different loans that are out there. So I usually like to start with the college's list first, because they've been working with these organizations for a long time. And if you do live in a state like Massachusetts, you can look at your local nonprofit lenders, see what they might offer, because they might have very competitive interest rates. So definitely utilize resources of places you can trust, and look for that transparency. That's really important. So let's talk a little bit about timing and what's coming up next. So bills are about to come out for the fall semester. They're usually sent from colleges in June or July and are due about 3 to 5 weeks later in July or August. Now this year, with colleges changing the timing of their academic year and different semesters, shortening semesters, things like that, it might be different at your college. Even if you're somebody who's already paid a bill last year, it might be a different timing this year. So check in with your school, find out what's going on as far as when does school start. What are the semesters going to look like this year based on the coronavirus? A lot of schools are making changes like that, allowing for some more online flexibility as well, which may also affect the cost. So be in touch with the school. That's your best resource to know what's going on. Hopefully, typically they'll have information on their website and be communicating with families as well. So when you do receive that bill, it may come in the mail, but more than likely it'll be on the student's web portal, so you can find it there. That bill is going to include only direct costs, so tuition, mandatory fees, if the student's on campus, room and board, and any other direct costs. If the student's living off campus, they're not going to charge you for rent. The school isn't, so you're going to have to pay for that separately, but you can borrow for that if you need to. Now, health insurance may be a charge that you might see on a bill. If you have health insurance and the student is properly insured with your plan And if the student's going out of state and you check with their insurance company that they'll be covered out of state, you can waive this cost. And it could be up to $2,000. Here in Massachusetts, every college, every student needs to be insured. So if a student doesn't have insurance, then the college will bill the student for their insurance plan. So you don't want to pay for that if you already have coverage. So make sure that you're doing that. You'll be getting instructions about that through your bill, through the college. Any enrollment deposits that you've paid, financial aid you've received, if you've sent the school any private scholarships that you've received, those should be taken off of the bill. If you don't see it as a credit on your bill, just touch base with the school, make sure they have that, because you don't want to have to overpay and then be looking for a refund. Set up that payment plan as soon as you can. Typically, those plans might start in May or June. Let's say it's a 10-month plan that starts in May. Well, here we are already in June. You might be able to reduce it to a 9-month plan or make a back payment for May and June and get started on that 10-month plan. Work study is typically not deducted from the bill. So if the student got a work study job and they're going to be working on campus, most colleges will pay the student in a biweekly paycheck, and the student can use that work study money to help pay for some of those unbilled expenses we talked about. So laundry, transportation, things like that. So you don't have to borrow for that. If you are looking at borrowing, we do recommend giving yourself at least 2 weeks to apply for the loan and make sure it goes through the whole process. Really, the process can be very quick. Once you apply, for example, through MEFA, and with most lenders, it's an instant credit decision. So you have that peace of mind, but you still need to sign your paperwork online. The college will need to certify it on their end, and then it will be credited towards your bill. And sometimes the colleges, they'll take an approval and a certified loan, but they actually don't want the lender to send the money until late August or September. So you're not going to be charged any interest on a loan until it's actually dispersed. So a lot of colleges like to wait until they know if students have gone through the add drop period before they get the loans in, so they don't have to do as many refunds. So just know that if you're approved and the school is certified the loan, it should show up as a credit on your bill. And maybe you're able to get through the first semester without needing to borrow, and that would be great. You can apply for loans at any point during the year. So maybe, come November, Christmas is coming up, you might be feeling the pinch a little bit, and you may decide, okay, we might need to borrow for spring, and you can do that. And definitely set up those payment plans according to the school's schedule. So we are doing a lot of work here at MEFA to offer families all of our services virtually. So typically in a normal year, we're out in the community, going to high schools and working with community-based organizations, meeting with families directly, as well as webinars such as this one. But right now, obviously, for health reasons and safety reasons, we're not able to do that this year. So connect with us on social media, whether it be Facebook, Twitter, LinkedIn, follow our YouTube channel. We'll be sending announcements of everything we're doing, all the great resources that are available through those social media channels. As well as, for example, on Twitter, we're often sending tweets of scholarships. So here's our 800 number as well as our email address, where you can call us at any time. We're open 9 to 5, Monday through Friday. If you need assistance, you can email your questions or at collegeplanning@mefa.org. If you do want to set up a one-on-one appointment with someone like myself or Jonathan, we have a few counselors at MEFA available. We can set up virtual appointments for you, look at your bill, look at your financial aid award, and help you create a strategy. So definitely utilize those resources. More than likely, you're signed up to receive MEFA's emails because you got this webinar. You got registered for this, so you're hopefully signed up for MEFA's emails, but if not, then feel free to sign up for those on our website and we can get you set up, because we will be announcing lots of great resources, such as when our new loan rates come out. We'll be sending that through email as well as on social media. So definitely stay connected beyond today. It's not just about this one webinar. It's about, helping you through the whole process and beyond. So we are going to open up for questions. While you're typing in your questions, type those in and we'll go through them. If you thought this was helpful, we'd love for you to write a Google review, and the link is right here. You can just type that in and let us know what you think. When I get this recording of this webinar later on, I'll email it to everybody registered, and there'll be a link to set up a MEFA appointment. So you can see the hyperlink right here, but it will also be in the email I send. So if you do want one of those one-on-one appointments, we can do that as well. So with that all said, I'll take a quick breath and a sip of water and turn over to Jonathan to shout out some questions for me.
Perfect. Thank you, Stephanie. And this was excellent. Thank you for all the wonderful information. So we do have a few questions from folks related to this section, and a few from prior, and some things you addressed already, but definitely want to bring them up. So one of them was, could you talk about how to handle the loan over 4 years, or could you address how to handle loans over 4 years of college, since there'll be different amounts each year? Would it get all rolled into one loan after 4 years? Do they sit as separate loans? Kind of, how does that work on a year-to-year basis?
Yeah, that's a great question. So it is an annual process. So, I'll just use MEFA as an example. Most lenders work the same way, where you'll have 4 separate loans at the end of 4 years if you borrow each year. So year 1, you have year 1's loan and that monthly payment. And then year 2, you borrow a new loan. It could have a different interest rate. You could even choose a different repayment option in future years if you wanted to. So it is an individual year-by-year loan. However, with that said, the loans are wrapped up under one account. So it's 4 separate loans, but you only have one account with MEFA, for example. So you can go online, easily make the payments. You're not going to have 4 different coupon books and things like that. They're separate loans, but they're consolidated billing. So it makes it easy to manage. And with our loan servicer that we work with, student and co-borrowers all have access to create online accounts, to make online payments, receive electronic documents, things like that. So it might seem overwhelming to think 4 years. We're saying plan for 4 years because we want you to make sure that 4 years of payments are affordable for you. But it is an annual process, just like applying for financial aid is an annual process.
That's great. Perfect. Another question we had, and you touched on this a little bit, but someone asked, they're having a hard time figuring out how much to apply for in the loan due to all the uncertainty about the upcoming academic year. The question is, if I apply, what if I apply for enough to cover tuition, room and board, and then come September, the campus is closed and they're doing remote learning from home? Can I reduce? Kind of, how does all that work? Yeah. With reducing loans?
Yeah, and it's an excellent question. There's a lot of uncertainty around this year. So what I would advise is to borrow what you think you need based on the current circumstances of what you're expecting. So if the college has said we'll be open, we'll have dorms open, you might want to wait until you get your bill. If you're not sure what that cost will be, you could wait and do that. Now, with that said, apply for the full amount that you think you'll need. And then as things change, call the lender and say, I don't need that much, only send, 10,000 versus 20 or whatever it might be, once you get a revised bill from the school. So you can always call to reduce it. You can reduce it later on in the year. So let's say the money is already sent to the school and you realize afterwards, oops, the money's already been sent to pay for the fall, but I don't owe that amount. I don't owe that much. Have the college, I'm using MEFA as an example because I can get into specifics, but it works similarly with many lenders. Call the financial aid office at the college, say, send MEFA back a refund. I don't need 10,000, I only need 5. And what we'll do on our end, once we get that refund from the school, and it has to come from the school, is we'll reverse interest on whatever that refund amount is. So if you had a $10,000 loan for the fall and you realize, geez, I only needed 5, have the school send us 5,000 back. We'll credit your account, reverse interest on that amount. So even after the loan's dispersed, there's still ways to adjust your loan amount and not be paying interest. So definitely call the college, call the lender. Don't keep a different loan. We've had students add that as well. So a lot of uncertainty around the timing and what might be. So just know that you can make changes and talk to the financial college.
Perfect. Couple more questions here related to MEFA, but I think it applies, to others. If I need to take out a MEFA loan for each year, can I do a different type of loan each year? Like, for first year would be a 10-year immediate, maybe second year 15 interest only, and so on.
Yep, yeah, you can do that. Once you've decided on a loan and you've taken out that loan is fixed for the life of that particular loan. So if you did a 10-year loan the first year, that is fixed for the life of that loan. However, next year you can do an interest-only loan or a deferred loan. At the end of 4 years, you could have 4 different loans with different rates and repayment options if you choose to. So it's good to stick with a lender if you're happy with that lender, of course, so that you have everything consolidated in one place. But you can definitely shop each year. Shop around. If you find a lender that has better rates, you can go with a different lender as well. But just know that you can take out new options and reassess each year, which you definitely should do, is reassess each year. It's a new billing period, new rates. So really look at it as an annual process.
Perfect. Another question we had, you mentioned that if the students take the full amount of the federal direct loans, that repayment is about $300 per month, give or take. The question is, how long will it take to repay? And I think it also brings up the point of maybe touching a little bit on the various repayment options available with the direct loan.
Yeah, that's a great question. So when students graduate and they're put into repayment, they're going to be put into a standard 10-year repayment. So that $300 a month is based on a standard 10-year repayment. Now, with that said, students, who knows, they may go on to graduate school and they may borrow more, and that 10-year payment might be a little too tough for them. So the Federal Department of Education has great repayment options for students that allow them to extend the repayment. There's different types of graduated repayment, for example, is another option where maybe when the student first gets out of school, it's still a 10-year loan, but maybe the first 3 years there's a lower payment. It goes up 3 years later, and then the last 3 years there's a larger balloon payment. Hopefully they're established and able to take that on. But there's consolidation through the Federal Department of Education. There's lots of different repayment options that you can choose from. And, there's even ways if a student, God forbid, is out of work and can't make any payments, that you can call and work with the loan servicer on your federal loans to, get those payments suspended for a while, which is called forbearance. So there's lots of different resources available. I guess the biggest advice I have, whether it's a federal student loan or any loan, is to work with the loan servicer if you're having any issues, to see what options they have available.
Perfect. Absolutely. I think that is every question that I'm seeing. Certainly we can hang out a little bit more if folks have any others, but we are 1 minute of 1 o'clock, so well done.
Yeah, right on time.
On the timing.
Yeah, so feel free. We'll stay on the line a couple more minutes. If anybody wants to type any questions in, we'll keep the webinar open for another minute or two. And for those of you who do have to sign off, we want to thank you for attending. We will send you the recording of this webinar as well as a link to set up an appointment if you need to. And leave us a Google review if you thought it was helpful. Thanks so much for attending, everybody. Thank you, Jonathan, for helping with the questions. And have a wonderful day.
Absolutely. Thanks. Thanks, Stephanie. Have a great one, everyone.
Do we have more questions that we want to answer, Jonathan, or?
Oh, Stephanie, actually, one question that did come up had to do with shopping around for different loan resources.
Yep.
I know that typically, if it's close together, it's not going to have a great impact on the credit score. But just, I don't know if you could talk a little about that.
Yeah, that's a good question. So if you're shopping around for one particular type of loan, such as an education loan, within a 30-day window, it only counts as one hit on your credit report. So if you want to shop based on rates, you can do that. You can also ask lenders, find out through different credit reports and different online resources what your credit score is. And you can even call the lenders to see what type of scores they're looking at so you can get an estimate before you actually apply. So that's a great question.
Perfect. And I believe that is all the questions.
Okay, great. All right, everybody. Well, thank you very much.